Hi, I'm Boyd Bender from WEA Trust Member Benefits, and today we're going to discuss the Wisconsin Retirement System, which is Wisconsin's retirement plan for teachers and other state and local government employees. We've broken this discussion into three easy-to-follow modules, and in Section 1, we're going to cover the basics of WRS, so what you need to know and how this important benefit fits into your overall retirement plan. We're going to talk about the core versus variable fund, taxes, dividends, and more.
So before we get started today, we've presented this list of questions which are the most common questions that we hear about the Wisconsin retirement system. To answer the first question, WEA Trust Member Benefits and WRS, are they different or are they the same?
WEA Trust Member Benefits is the company that I represent, and we've been helping Wisconsin public school employees achieve their financial goals for over 40 years, and we've been doing that by providing personal insurance and retirement and investment programs. One thing that's important for you to understand is that we operate as a trust, so we do reinvest any profits that the business makes back into the programs that benefit you, the participant. So we don't have any shareholders, and that allows us to focus on meeting the needs of those that we're serving. And we do that through high-quality products that are competitively priced rather than focusing on making a profit for shareholders. We administer voluntary programs such as the 403B or TSA, IRA, auto and home insurance, and individual long-term care insurance. And we also do financial planning on an individual basis. We can answer general WRS questions, but we don't have access to your personal specific WRS account information. We do offer individual consultations, and we have more information available at our website, weabenefits.com. To contrast, the Wisconsin Retirement System is one of several benefit programs that is administered by the Department of Employee Trust Funds, and that's a state agency. WRS is considered the group pension for Wisconsin public employees. Then, if you had questions about your specific account, you would contact the WRS for that information, and they have a toll-free number that you can call. They have a wealth of general information at etf.wi.gov. They do not currently have your specific account information available online. You would need to call their office to ask about that. So first I want to set the tone for our discussion today, and I think that it's helpful just to understand where the WRS fits into the grand scheme of your retirement income. The pie chart that we're showing is going to demonstrate what the typical Wisconsin public school employee looks like in terms of retirement income. So the green slice of the pie, we're making some assumptions. First of all, we're estimating that 40 to 50% of your pre-retirement earnings are replaced by your WRS pension. So the assumptions that we use to get there are that you have 25 to 30 years of creditable service in the state of Wisconsin, and that's what arrives at that 40 to 50%. So we're going to talk more about creditable service and what that means and how it's calculated in Section 2, but for now I just want you to understand we have made that assumption to arrive at that percentage. If we move along to the yellow slice of the pie, we're representing Social Security. And here we're estimating that to be 14 to 28%. Finally, we have the blue, and that is what you're personally responsible for. That's going to be your 403B or IRA savings. If you had work in retirement, that could certainly be in that category. And the blue is going to be how you determine the quality of your retirement, allowing you to do the things that you've always dreamt of doing. And the estimate on the blue slice is going to be 22 to 46%. But in terms of our discussion today, we are going to narrow in and focus solely on the green slice of the pie, which is the Wisconsin retirement system at 40 to 50%. So that's where this discussion fits. To get started, we're going to talk about a number of concepts that are important to understand in general terms and also define a few terms that the WRS uses in talking about your pension. First, during your employment years, contributions are going into your account. And that has always been the case, and those contributions have always been split 50-50 between an employer and employee share. What has changed recently is that employees are now responsible for paying the employee share. And again, that's half of the total contribution rate. Because in the past, the employer typically made that employee share contribution for you. So in today's world, you are making that 50% contribution, and the employer is continuing to pay the other half, which is called the employer share. The total contribution rate is redetermined on an annual basis. So that means it can go up or it can go down year to year. If more money is needed to maintain a healthy funding level, then contribution rates are going to go up. If the funding level is above what they need, and that could be perhaps due to good market returns, contribution rates could go down. So I want to give you a bit of perspective. Here are the historical overall contribution rates for teachers and general category employees. So going back since 1990, the lowest overall contribution rate was 9%. And that happened in 2001 and 2002. On the other hand, the highest contribution rate happens to be this year, 2014, at 14%. But historically, a typical contribution rate or an average looks to be in the 10 and mid 11% range. Now, moving on to the next concept, the earliest retirement age when you can draw a benefit is age 55. And there is one exception to that rule, and that is for folks who are in the protected service category. So, for example, that would be police or fire. Their earliest retirement age is 50. But in either case, regardless of your category, you do not have access to any of this money while you're working. So with that understanding, it brings me to a point where I can have a discussion about probably the most frequent member question that we've received over the last couple years at least. And that is WRS a good system and is it safe? And let me start that answer by saying that the WRS is a pre-funded pension. So we just got done talking about contributions during your working years. So those contributions are being set aside to pay your future benefits. That contrasts with a pay-as-you-go system, where contributions of current workers are paying the benefits of retirees. So just right off the top, understanding that it's a pre-funded pension should give you some peace of mind, because that is by far the more desirable method for structuring a pension. Secondly, each year an actuarial valuation takes place, and that is done to determine what's called the funded ratio. So what percentage of the money that's going to be required to pay the future benefit obligations actually exists in the trust fund. Now, unfortunately, some public pensions and some that you've probably heard about are woefully underfunded. And I've heard ratios in the near 50% range, which means they only have about half of the money required to pay the benefits that they've promised. Good news, though, is on the other hand, the WRS has consistently been one of, if not the strongest, funded state pension in the country, and that's due to its funded ratio. The last, most recent valuation determined that the WRS funded ratio was at 99.9%. And there's some pretty good reasons why WRS is so well funded, but a major reason is in its design. So to answer that question, is WRS good? Is it safe? Can I count on it? My answer is yes to all those questions. And the reason for that answer is the funded ratio. And it's strong because of the flexible contribution structure, where we talked about that contribution rate that can go up or down each year. So we're really fortunate to have a public pension in Wisconsin that is consistently ranked as one of the best run public pensions in the country and in the world.
So let's move on to the idea of what happens to those dollars after they go in. By default, if you don't make a conscious election otherwise, your dollars would be deposited in what's called the core investment fund. And a number of years back, they renamed this trust fund. It used to be called the fixed fund. core is a little bit more accurate in representing the investments that are held. It's about a 65% stock and 35% bond mixture. So it's kind of a moderate allocation. You do have the option to participate in the variable fund. And this is something that you would have to consciously elect to do. You need to file paperwork to participate. And regardless of when you file the paperwork to participate, it will not become effective until the following January 1st. So if you did elect to participate, what that means is that your future contributions only will go 50% to the variable fund and 50% will remain in the core fund. So you don't have the opportunity to choose how much. By default, it's a 50-50. Keep in mind, it only affects your future contributions. So often, folks who are mid-career or late career ask me, well, should I opt to participate in the variable fund? And my answer is, well, you can, but keep in mind that all of the money that you've accumulated up until this point is going to stay in the core fund, and only half of your ongoing contributions will go to the variable. So we're going to come back and talk about the variable a little bit later in a later section about opting out of variable participation. But for now, I just want you to understand how you opt in.
Next, let's discuss some different interest rate terminology used by the WRS.
And the two terms are effective rate and dividend rate. And what I want you to keep in mind is that at any one point in time, you can only be getting either the effective rate or the dividend rate. You cannot be getting both. The effective rate describes the rate of return that your account earns before you begin drawing your retirement benefit. So it's like the interest rate that's applied to your account. Once you elect to retire and begin your retirement distributions and receive a stream of monthly income, your benefit is then subject to something called the dividend rate. And dividend in this case doesn't mean what you may think of when you think of owning a stock. Dividend means an adjustment to your monthly benefit. And dividend can be a positive adjustment, but it also can be a negative adjustment. So we're going to explore that a little bit more as we proceed.
We also need to talk a bit about taxes.
We've established that contributions are going in throughout your working years, and those contributions are being made on a pre-tax basis. So those benefits, those contributions that are going in are not considered part of your earned income in the year that you earn them, but rather they will be taxed at the time that you take them out. And there are two primary types of withdrawals that an individual can take. Generally, it would be considered a retirement withdrawal, and that's for someone, again, who reaches their minimum retirement age and begins taking their benefit. Those dollars will be subject to ordinary federal and state income tax, but I'll pause on the state because you only are subject to Wisconsin state tax if you reside in the state of Wisconsin in retirement. So if you reside in a different state, for instance, Florida has no state income tax, then you would not be subject to state taxes. It will only be federal. And because this is not a payroll benefit or payroll money, it is not subject to FICA tax. The other less common type of withdrawal is called a separation benefit. And that describes someone who takes their retirement money out prior to meeting their minimum retirement age. And for most people, again, that would be 55. So I'm going to take you through what happens if that occurs. And I do this as just a way to demonstrate that hopefully you don't do this. The first thing that will happen is you will forfeit the employer share of your account, which is 50%. Second, if you take that distribution in cash, you would pay ordinary income, again, federal and state tax, plus a penalty tax, and that is 10% federal and 3 1/3% Wisconsin. So by the time you roll up, losing half of the account, paying ordinary income tax, and a total of 13% tax penalty, you can see that you don't end up with a whole lot left. So that's a word of caution. If you do find yourself no longer in state employment prior to your earliest retirement age, then my advice is to leave your account and do not draw it immediately. If you're listening to this and that sounds like something that you may have done, we will address how you can fix that in a later section.
This concludes Section 1, and I would encourage you to view Section 2, where we'll discuss how benefits are calculated, step through the different formula benefit components and also take a look at how to read your WRS statement. Thanks again for joining us today.